Hey folks, welcome back to the channel. Make sure to subscribe, like, hit that notification bell. That way you get the most up-to-date videos. And today we're going to talk about our monthly update. So let's talk about what actually happened in the markets in January. Because if you only followed the headlines, you think the world was ending again. And yet stocks hit new highs, bonds held up, and long-term investors were reminded of an important lesson, which is markets can be noisy, but fundamentals still matter. Let's start with the scoreboard. The S&P 500 gained about 1.4% in January and even crossed 7,000 intraday for the first time. The Dow was up 1.7% and the Nasdaq up just under 1%. The international markets were the real standout though. Developed markets up over 5% and the emerging markets nearly 9%. Meanwhile, bonds were modestly positive even as interest rates moved higher, with the 10-year Treasury ending the month around 4.24%. Translation: despite volatility, balanced portfolios work the way they're supposed to. Let's hit on volatility and geopolitics. Now, volatility definitely showed up. The VIX popped above 20 at one point thanks to geopolitics. We had a couple things: a U.S. operation in Venezuela, tensions tied to energy markets, even headlines around Greenland and NATO that briefly spooked investors. Here's the key takeaway. Geopolitical events often feel massive in the moment, but history shows their long-term impact on markets is usually far smaller than the headlines suggest. Markets sold off, then recovered, then moved on. That pattern hasn't changed. Let's hit on the Fed, the rates, and the dollar. The Federal Reserve held rates steady in January after cutting rates 3 times in the back half of 2025. Inflation, well, still cooling, but not gone. CPI is running around 2.7% above the Fed's long-term target. Late in the month, markets reacted strongly to news that Kevin Warsh was nominated as the next Fed chair, which he's expected to take over in mid-May. That mattered because markets hate uncertainty, and this reduced at least some of it. Now let's hit on some favorites: gold, silver, and shiny objects. Because January was a roller coaster for them. Gold surged to record highs. Silver went even more extreme, and then both dropped sharply at the end of the month. Folks, that's a reminder that gold is not a savings account. It's a volatile asset. Precious metals can absolutely play a role in portfolios, but January showed exactly why they should complement a plan and not replace the entire thing. If something can move 10% in a day, it probably shouldn't be your entire retirement strategy. And let's hit on some corporate earnings, what I believe is the quiet hero. While headlines focused on politics and metals, corporate earnings quietly did the heavy lifting. About 75% of companies reporting beat expectations, and earnings growth is tracking close to double digits again. Yes, AI and tech continue to get the spotlight, but earnings strength has been broader than most people realize. It's a big reason markets stayed resilient despite all this noise out there. Let's also hit on some short-term disruptions that we had. We saw severe winter weather across much of the US, which disrupted travel, retail, and construction. Historically, events like this tend to delay economic activity, not destroy it. Another example of short-term disruption that rarely changes long-term outcomes. So what is our perspective? Well, the bottom line for January is this. Volatility showed up, headlines were loud, markets stayed resilient, fundamentals did their job. For long-term investors, January reinforced a simple truth. A disciplined plan beats reacting to headlines. At Frame Wealth Partners, our job is to help you stay focused on what actually matters, which are your goals, your timeline, and your plan. Thanks for watching. We'll see you next month.